When you turn on the news, it can feel like you're getting two completely different stories. One headline says consumers are struggling. The next says the stock market is at an all-time high. So which is it? I'm Patrice Sikora with your host, Jim Kruzan, and today we're discussing why the economy can feel confusing, why your personal experience may not match the headlines, and what investors should focus on when the data seem to send mixed signals. All right, Jim, over to you. Why does the economy feel so different to different people?
Yeah, there's a variety of reasons, and certainly there's been a lot of talk about this. Um, Many economists have been talking for the last several years about this K-shaped economy. The letter K has this ascending leg to it, and it also has a descending leg. And it just depends on which leg you find yourself on. It kind of determines how you feel about things. Those who have higher income or have a larger percentage of their net worth in the market, they're probably feeling okay. They certainly see their wealth grow, and while there might be higher prices at the grocery store, their wealth kind of, no pun intended, trumps that, and they feel pretty good about things. Conversely, if you're on that lower leg, lower income, you're struggling. You see it all the time. There's concern of employment. Your wages are not keeping up with inflation. And you certainly see it in the reality of grocery store prices as well. That's one issue. Another big issue is how your expenses kind of lay out. Are they more fixed or variable? You know, if you have a home that's paid off, you're probably not feeling nearly as much pain. If you have a home that has a mortgage that has a very low interest rate, fixed rate, there's some certainty in terms of your expenditures, which help as well. If you're on the variable camp, you're renting, you're subject to rate increases just about every single year. If your debt is variable rate, think of that as credit card debt and or variable rate mortgage, you've seen a huge increase in your interest rate expenses, which certainly have an effect as well. Beyond that, there's been a lot of talk of boom session. It's a word. It's kind of the combination of boom times and recession. And that has a lot to do with, you can look at certain pieces of macroeconomic data, like, oh, the unemployment rate doesn't seem so bad, or, oh, it looks like GDP is growing, it's positive, and get the idea that things are just fine. But then at the other end, you know, most of us deal with things that are just a whole lot more personal, and we see it in the grocery stores and we see it in pricing. So there's this dislocation. And you also said it in the intro. There's this social media kind of dysmorphia where folks kind of look at a lot of data. They look at clickbait news, and people who probably are normally financially stable start to feel the woes of all of this news and feel like maybe they're not quite as positioned as they should be. Or conversely, you have an awful lot of people as well that maybe overspend and get into serious debt because they feel a need to keep up with the Joneses, keep up with an unrealistic alternative reality that they see through that as well. So all of those things combined create this dislocation between what's really happening in the economy and how we all feel about it.
That's a great explanation of why two people can look at the same information and come away with two different impressions. But explain to me how consumer confidence can be so low and the stock market can be so high.
Yeah.
Where's the disconnect? I mean, there is a disconnect, but talk about that.
Yeah, it's really an informational gap. You know, stock markets are they kind of exist to telegraph the efforts in maximizing profit. Individuals tend to look at things in terms of maximizing personal utility, and that's entirely different. So individuals look at, gee, how far did my paycheck stretch this month? Wow, those grocery bags that I buy every week are costing more. Or another way of looking at that is, gee, $100 that I spend in groceries hardly fills up a single bag anymore, where I remember
Hmm.
when it was multiple bags. The famed economist, Ben Graham, who is considered the father of value investing, he taught Warren Buffett, amongst others. He had a famous quote years and years ago that basically said, in the short term, the stock market is a voting machine. But in the long term, the stock market is a weighing machine, which means in the short term, we get kind of blindsided or we get wrapped up in the euphoria of the moment. People like to seize these trends, and the market can get a bit carried away. But in the long term, it really has more to do with stability of the business plan, stability of the market that you're in, whether the expectation of improved productivity really pans out or not. So you get these huge euphoric surges, and then over time, and it can take several years, things tend to set back down, which I find really interesting. So the reason for that is the market is forward looking. And because of that, it can get kind of wrapped up in its own story. We're seeing a little bit of that now with respect to AI. Another reason is there's some degree of wealth inequality. While a lot of people participate in 401ks and that, but real market wealth is a bit more concentrated. You've got those who have it and kind of those that don't. So the vast majority of us who really don't feel the pain of kind of day-to-day activity. Beyond that, there's also a big dislocation between the need to drive corporate profit and what that means in terms of our personal wallet. As an example, a corporation to drive profit may try to find ways to increase revenue. They might find ways to reduce expenses. Those expense reductions might have to do with reducing the labor force, which then directly has an effect on consumers' wallet share and those kinds of things as well. So you get these big dislocations in part because one is kind of tracking something while the other consumers are reacting to something entirely different.
I love the way you said that the market is forward looking, which kind of suggests that consumers are in the here and
Mhm.
now. They're not looking at the same
Mm-mm.
things.
No, not at all. And that also relates to um, a lot of issues like innovation, um, how we feel about or how we get excited about something. The purpose or the utility of an innovation, as an example, um, might be valid, but
Hmm.
that innovation, as it relates to um, a successful investment or a valued investment today might be entirely different. As an example, AI might be everything that it's hoped to be, but an AI investment based on certain circumstances today, price, value, those kinds of things might not be the case, right? So we see that often. Um, it's interesting because throughout history, we've had those situations where the stock market um, is moved quite a bit, or corporate profits are concentrated to a great degree on what the new innovation is, what the new kid on the block is. And we've seen that. And there's kind of a common cycle that happens. Once this innovation becomes commonplace and is more readily adaptable, it opens the floodgates to an awful lot of investment, floodgates to venture capital, floodgates to use of debt to further expand investment in that space. And those excesses ultimately always kind of roll over. I was in prep for this. I was kind of going back and thinking of certain periods of time. We certainly have this period today with respect to AI that a lot of people are kind of comparing to the dot-com bubble 25 years ago. But just 6 years ago, 2020 to 22, we had kind of that crypto and NTF craze. You might remember
Right,
that.
right, right.
And
NFTs, yes.
everybody talked about it, and everybody wanted a piece of it. And the industry was trying to figure ways of making it even more available and more democratic for investors to participate. And then after 2022, many of those same cryptos dropped 70%. Some dropped 90% or more. Some just failed to exist. They're here today, but they're certainly not the investment they were back then. And that was just 6 years ago. And then we had the dot-com bubble, the same thing, the enthusiasm over the productivity that'll be released by the internet created a situation where you had overinvestment, overenthusiasm, and the use of a lot of debt, which led to a nearly an 80% drop in the NASDAQ. Not talking about crypto here. We're talking about the NASDAQ, which is a very large index. And that created an awful lot of pain. And then, prior to that, the next big innovative bubble that we had in our country was electricity and the electrification of the U.S. There were hundreds and hundreds and hundreds of electrical companies. Many of them got an awful lot of investor money. Many of them overbuilt for the time or the capacity needed, and they used a lot of debt and got into trouble. Radio was the same thing. The most speculative stock in the United States leading up to the Great Depression was RCA, Radio Company of America, right?
I did not know that.
It
Yeah.
and people and it was crazy what it was worth in terms of price to sales, price to revenue, price to everything, and it was speculative, and that's not the only time. Also, in our country's history, new technology, believe it or not, were railroads and mass transportation, and in the 1840s to 1850s, there was incredible speculation there. And it was the same story. It was a lot of enthusiasm, a lot of institutional investment, a lot of individuals investing in hundreds and hundreds and hundreds of railroad stocks, many of which ultimately failed, and a lot of debt that was used as well to accelerate the investment in that space. And then there was a huge consolidation, and that led to the financial crash of 1857, which we all know about.
That's right.
Just
Yeah.
kidding. Nobody knows about. But just the same, it's the same story over and over. Now, so innovation certainly drives stock market performance. It does drive profit because there's a lot of people buying a lot of stuff right away. But ultimately, as Ben Graham said, it's a weighing machine, not a voting machine. And all those things kind of have their day.
Well, now with that little history lesson, what is it that investors should really be looking at?
Yeah. There's if you like data and you're kind of data centric, there certainly is an awful lot of stuff out there that you can pay attention to. But for the average consumer, the average guy out there is working for a living, trying to put some money away with the hopes of having a really successful retirement, I would say the biggest data point you might want to take a look at is just generally what's happening with inflation. And when you look at inflation, you can look at two sets of data, the CPI number or the PCE number. CPI, Consumer Price Index, we know all about that. The other, the personal consumption expenditure number. They both do the same thing. They just do it a little bit differently. One is a little bit more broad-based. That's the PCE. But if it's going up, that can be problematic because generally that's going to drive a change in interest rates, presumably causing those to go higher. Higher interest rates become a huge headwind for the economy. It also becomes a headwind for stock market valuations or price multiples to a large degree ebb and flow with prevailing interest rates. So that would have a big effect. Beyond that, obviously, taking a look at the employment numbers, is the job market doing well? That helps with consumer confidence. Consumer confidence is another area. A lot of people look at that as a a leading indicator. I think it's more of a neutral indicator. There's certainly some evidence that it may even be lagging. Is it the tail that wags the dog or vice versa? You know, if we're seeing layoffs and those kinds of things, does that sour the consumer's opinion? And then does that drive a reduction in consumption, or is it the other way around? Uh,
Right.
that makes sense. Probably the least useful is, quite honestly, corporate profits, or whether they're trending higher
The
or lower.
the least useful?
I would say,
Now the others,
yeah,
I would argue most of the others are lagging
yeah,
indicators. So talk to me about how profits would be least useful.
yeah. Again, this is just my. I mean, it's an important data point, obviously, from the standpoint of investing. But the problem with corporate earnings are they can easily be manipulated. A good accountant can take something that normally historically is an expense that would reduce profitability and figure a way of capitalizing it and sticking it on a balance sheet as if it doesn't even exist, which overemphasizes profitability. So when you look at profits from, hey, what are the profits today versus where they were 10 years ago? You're looking at two entirely different environments where tax code may be different. And if you were to rerun the numbers using kind of a standard form of revenue, direct expense, operating expense, profit, you might find the numbers are completely different. You see that a lot.
Got it.
Today,
Yeah.
the big game with AI stocks is they're using a lot of their free cash flow. They're going out in the open market, buying back their own shares of stock, which then reduces the number of shares outstanding. So every
Mm-hmm.
quarter they deliver better earnings per share because there's less shares out there. Is that really better earnings? Or is it just simply you're not giving that money back to shareholders as dividends? You're going back and buying stock, which then enriches the managers and everybody else who has compensation geared towards stock market performance, right? So
Got it. Yeah.
that's why, for the average consumer, profits and a comparison of profits are somewhat nebulous.
Got it. That does make
Yeah.
sense. Yeah. Yeah. All right. So what is a poor consumer to do?
Yeah, it's not hopeless. It's we just have to understand that, as a consumer, for that matter, as a financial advisor, you're not making adjustments or assumptions on just day-to-day news flow. The turn of the economy from one day to another, or in our economy as it is today, the latest tweet to the next tweet. It just doesn't make a lot of sense. Remember that, the goal isn't to maximize each turn of the economy or the market on a day-to-day basis, but rather design an overarching plan whose purpose is to help reduce the effects of uncertainty. And when times get tough, or there's some concern or anxiety as a result of news flow, etc., it probably makes sense to take a step back, review the plan in place and why the plan was put in place to achieve the goals you have, and then reconsider whether those are still the same goals you have. If not, we might have to change the plan. But if those goals are the same, then the plan probably holds pretty well, and we go from there. And I think there's more positive that comes out of that approach than just panic and, oh, do you see this news clip? Or, oh, I heard this number was up, down, or sideways,
Right. Right.
at least in the
When you
short
talk
term.
about Right. Well, when you talk about a plan too, let's talk long term and look at retirement. I mean, lots of people heading into retirement or in retirement look at these numbers and they may get a little freaky.
Yeah, it's the same thing. It's all about having the plan in place. What that is, it's the plan in terms of retirement
Right.
is vastly more complicated, or it should be, than just what the stock market is doing or just what my investments are doing as well. You can achieve great things as it relates to one's retirement by focusing on a lot of other strategies and tactics beyond just simply what's happening with the market now or this quarter or this year. Making the right choices on use of debt, making the right choices on when to retire, making the right choices of how you take a pension if one is afforded to you, making the right choices on Social Security, etc. And then overlaying a tax consciousness where we need to be aware of and smart about how we take this money out. The less tax we pay over time, the more money we have. The less tax we pay, the longer the runway is in terms of consuming that wealth. So those things are vastly more important than, are we going to fall into a recession today or not?
Yeah. All right. So it's retirement. It's the plan, all about the plan.
It always is about the plan.
So much in here to consider, Jim. So much. Is there something you haven't mentioned that you want to make sure we do?
I really don't think so with respect to this topic. The one thing I would say is make sure you tune in to the Retirement Engineer. We put out some really great content, and we try to find interesting topics to talk about that may touch and affect every listener. So keep listening.
The important thing to remember is that no single headline or economic indicator tells the whole story. And that's why it's important to keep your focus on your long-term goals and the plan you've built to help you reach them. If today's discussion raised questions about your retirement plan, investment strategy, or long-term goals, we encourage you to reach out to your financial advisor. If you are looking for guidance and you don't currently have an advisor, visit kaydanwealth.com to schedule an introductory call with our team. And if you'd like to stay informed between episodes, be sure to join our mailing list to receive our monthly market and economic updates. Each month, we share our latest observations on the economy and markets, discuss the data we're watching, and provide perspective on what we're seeing and how we're thinking about it. Follow @KaydanWealth on social media and let us know what you think in the comments. Your feedback and your topic suggestions help us improve and make a bigger impact. Thanks for being with us.
Thank you for listening to The Retirement Engineer with Jim Kruzan. Click the follow button to be notified when new episodes become available. Visit our website at www.kaydanwealth.com or give us a call at 800-638-6900. The information covered and posted represents the views and opinions of Jim Kruzan and this episode's guests, not necessarily those of Kaydan Wealth Management. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.